As Bitcoin continues its relentless climb in 2025, a question echoes through the minds of every investor. Are we near the peak? The air is thick with a familiar mix of euphoria and anxiety. Many look at the charts and see only blue skies ahead, while others nervously eye the calendar, remembering the brutal corrections of cycles past. It is a critical juncture where fortunes are made and lost. The prevailing sentiment suggests that this bull market has more room to run, yet the ghosts of 2017 and 2021 remind us that market tops often arrive when least expected, leaving unprepared participants in financial ruin. It is crucial to approach this phase with a clear head, armed with data rather than emotion. The truth is, nobody can predict the exact top with perfect accuracy. However, we can use historical data, on-chain metrics, and macroeconomic context to build a probabilistic framework. This bull run feels different in many ways. The introduction of spot ETFs has fundamentally altered the landscape, bringing in a wave of institutional capital that was absent in previous cycles. This new dynamic complicates traditional cycle analysis. While the core principles of supply and demand remain, the players and the scale of their influence have changed dramatically. The question is not just when the peak will occur, but how it will form in this new environment. Will it be a sharp, violent blow-off top, or a more rounded, prolonged distribution phase? Even if the Bitcoin peak is on the horizon, the story for the broader crypto market is far from over. Historically, the most explosive gains for alternative cryptocurrencies, or altcoins, occur in the final, most speculative phase of the bull market. This period, often called altcoin season, is when capital rotates from a peaking Bitcoin into higher-risk assets, chasing parabolic returns. Therefore, understanding the relationship between Bitcoin's dominance and the flow of capital is just as important as trying to time Bitcoin's own cycle top. For many, the greatest opportunities of this cycle may still lie ahead, waiting to be unlocked after Bitcoin signals its final major move. Navigating this environment requires a dual focus. On one hand, we must diligently watch Bitcoin for signs of exhaustion and distribution. On the other, we need to prepare for the potential capital rotation that could ignite the altcoin market. This means staying grounded, avoiding the siren call of extreme leverage, and sticking to a well-defined strategy. The goal is not to catch the absolute top or bottom, but to successfully navigate the market's ebbs and flows, preserving capital and capitalizing on high-probability opportunities. The coming months will test the discipline of every market participant, separating those who follow a plan from those who are guided by fear and greed. At the core of Bitcoin's long-term price behavior is a remarkably consistent pattern known as the 4-year cycle. This cycle is anchored by a programmed event called the halving, which occurs approximately every 4 years, or every 210,000 blocks mined. The halving cuts the reward that miners receive for validating transactions in half, thereby reducing the rate at which new Bitcoin is created. This predictable reduction in supply has historically been the primary catalyst for each new bull market. By understanding this rhythm, we can gain valuable perspective on where we currently stand and what might come next. Each 4-year cycle can be broken down into distinct phases. It typically begins with a bear market bottom, a period of despair and accumulation that follows the previous cycle's peak. This is followed by a slow, steady recovery, leading up to the halving event. After the halving, the supply shock begins to take effect, usually kicking off the most aggressive phase of the bull market where prices appreciate rapidly. We are currently in this post-halving expansion phase following the April 2024 halving. History shows this is the period where Bitcoin typically prints its most significant gains, as demand begins to outstrip the newly constrained supply. Looking back at previous cycles provides a useful, albeit imperfect, roadmap. The 2012, 2016, and 2020 halvings all preceded massive bull runs that peaked approximately 12 to 18 months later. If this pattern holds, it suggests the peak for the current cycle could arrive sometime between late 2025 and mid-2026. However, it is crucial to acknowledge the theory of lengthening cycles and diminishing returns. Each successive cycle has been longer than the last, with a lower peak return on investment. This implies that while history is a guide, we should not expect an exact repeat of the past. The market is larger and more mature now, which naturally leads to less volatility and more drawn-out trends. Therefore, while we are clearly in the bull market phase, the exact timing and magnitude of the peak remain open to interpretation. The 4-year cycle provides a strong foundational thesis, but it must be supplemented with other data points to form a complete picture. Factors like institutional adoption, regulatory developments, and the global macroeconomic climate are playing an increasingly important role. By combining the cyclical rhythm of the halving with a nuanced understanding of the current market environment, we can better position ourselves for the opportunities and risks that lie ahead in this exciting phase of the market. While the halving remains a cornerstone of Bitcoin's narrative, its direct impact on supply dynamics is mathematically diminishing over time. In the early days, each halving represented a massive shock to the system. The first halving in 2012 cut the new daily supply of Bitcoin from 7,200 to 3,600, a dramatic 50% reduction in the inflation rate. The second halving in 2016 reduced it from 1,800 to 900. However, the most recent halving in April 2024 reduced the daily new supply from 900 BTC to just 450 BTC. While significant, this reduction is much smaller in absolute terms, and relative to the total existing supply of over 19.7 million Bitcoin. This concept is often referred to as the law of diminishing returns. As Bitcoin's circulating supply approaches its maximum cap of 21 million, each subsequent halving removes a smaller and smaller fraction of the total potential supply from the market. The daily issuance of 450 BTC is now a mere drop in the ocean compared to the millions of BTC that are traded daily on exchanges. Consequently, the supply-side shock from the halving event itself is becoming a less powerful driver of price. The narrative and psychological impact may remain strong, but the direct mathematical impact on supply and demand is undeniably weakening. This evolution means that other factors are beginning to exert a greater influence on Bitcoin's price. In previous cycles, the halving supply crunch could single-handedly propel the market upward. Today, the demand side of the equation has become far more critical. The approval of spot Bitcoin ETFs in the United States, for example, has unleashed a new, sustained source of demand that can easily dwarf the reduction in minor issuance. On any given day, the net inflows into these ETFs can be 10 times greater than the amount of new Bitcoin being mined. This shifts the focus from the programmed reduction in new supply to the fluctuating and often unpredictable waves of institutional and retail demand. As we move forward, we should expect Bitcoin to behave less like a pre-programmed machine driven solely by its issuance schedule and more like a mature global macro asset. Its price will be increasingly influenced by factors like interest rate policies, global liquidity conditions, and investor risk appetite, much like gold or the S&P 500. The 4-year cycle narrative will likely persist as a powerful psychological anchor, but the underlying mechanics are changing. The diminishing impact of the halving is a natural part of Bitcoin's maturation process, signaling its transition from a niche technological experiment to a significant component of the global financial system. In its early years, Bitcoin was largely an isolated asset, moving to the beat of its own drum, almost entirely disconnected from traditional financial markets. But, that reality has fundamentally changed. Today, Bitcoin's correlation with the stock market, especially with tech-heavy indices like the Nasdaq 100, has grown significantly. This is really a natural consequence of its increasing adoption by mainstream investors and institutions. When these participants view Bitcoin as a high-growth, risk-on technology asset, they tend to buy and sell it in tandem with their other risk assets like tech stocks. This creates a stronger link between the two markets, especially during times of major economic shifts. We've seen clear examples of this relationship in recent years. During the macro liquidity crisis of March 2020, Bitcoin crashed right alongside the stock market, showing that in a true panic, all risk assets are sold off indiscriminately. Conversely, during periods of quantitative easing and low interest rates, both Bitcoin and equities have soared. The price action of 2024 and 2025 has continued this trend. When the Federal Reserve signals a more dovish stance or when positive inflation data boosts the stock market, Bitcoin often sees a surge in price shortly after. This really shows that the flow of global liquidity is a primary driver for all risk assets, and Bitcoin is no exception. Global liquidity, which is essentially the amount of money sloshing around the financial system, acts as the tide that lifts all boats. Central bank policies, especially those of the U.S. Federal Reserve, are the main determinants of this liquidity. When central banks are printing money and keeping interest rates low, it encourages borrowing and investment, pushing capital into higher-risk assets like Bitcoin. But when they tighten policy by raising rates and reducing their balance sheets, liquidity dries up, and investors tend to flee to safer assets like cash and government bonds. So paying attention to Federal Reserve meetings, inflation reports like CPI, and employment data is now just as important for a Bitcoin investor as analyzing on-chain metrics. This growing correlation means that the idea of Bitcoin as a perfect, uncorrelated hedge is really being tested. While it may still offer diversification benefits over the very long term, in the short to medium term it's clearly susceptible to the same macroeconomic forces that affect traditional markets. As we try to gauge the potential for a market top, we must look not only at Bitcoin's own cycle, but also at the health of the broader economy. A significant downturn in the stock market, triggered by a recession or a hawkish pivot from central banks, would almost certainly put a premature end to Bitcoin's bull run, regardless of where we are in the 4-year cycle. While no one can pinpoint the exact peak, various models and indicators can help us identify potential price targets and warning signs that the market is becoming overheated. One popular tool for projecting price targets in uncharted territory is the Fibonacci extension model. By drawing Fibonacci levels from the major swings of the previous cycle, like from the 2017 top to the 2018 bottom, analysts can project potential resistance levels for the current cycle. Historically, Bitcoin's cycle tops have often landed between the 2.618 and 3.618 Fibonacci extension levels, providing a broad but useful target zone to watch as the price continues to rise. Beyond simple price projections, on-chain indicators provide a deeper look into the market's health. The Pi cycle top indicator is a famous and historically accurate signal that has marked the peak of the last 3 major bull runs within a matter of days. It consists of 2 moving averages, the 350-day simple moving average, multiplied by 2, and the 111-day simple moving average. When the shorter-term 111-day SMA crosses above the longer-term 350-day times 2 SMA, it has historically signaled that the market has reached a point of unsustainable parabolic euphoria. As of mid-2025, these moving averages are still far apart, suggesting we have not yet entered that final speculative blow-off phase. Another classic momentum oscillator is the Relative Strength Index, or RSI, which measures the speed and change of price movements. The RSI is typically plotted on a weekly or monthly scale to gauge long-term market momentum. In past bull markets, a weekly RSI value above 90 has been a strong indication of an overbought market nearing its peak. While brief spikes into this territory can happen, a sustained presence in the 90-plus zone signals that a major correction is likely imminent. Monitoring the RSI can serve as a valuable thermometer for market sentiment, helping to warn us when euphoria is reaching a dangerous extreme. Ultimately, these tools are not crystal balls but rather instruments in a broader analytical toolkit. They provide probabilities, not certainties. The most prudent approach is to watch for confluence, when multiple independent indicators begin to flash warning signs at the same time. For example, if Bitcoin's price enters a key Fibonacci extension zone while the Pi cycle top indicator is about to cross and the weekly RSI is screaming above 90, the probability of a major top being close becomes substantially higher. Waiting for this confluence of evidence can help investors avoid exiting the market too early, while also providing a clear signal to begin taking profits and reducing risk. One of the most anticipated phases of any crypto bull market is the so-called altcoin season. This is the period when alternative cryptocurrencies, many of which have been lagging for months, suddenly experience explosive parabolic price increases, often outperforming Bitcoin by a wide margin. This phenomenon is driven really by a predictable rotation of capital. Typically, capital flows first into Bitcoin, driving its price up and increasing its market share relative to the rest of the crypto market. This is measured by an important metric known as Bitcoin dominance, or BTC.D, which represents Bitcoin's market capitalization as a percentage of the total crypto market cap. The prelude to a major altcoin season is usually a rising and then peaking Bitcoin dominance. As Bitcoin approaches its own cycle top, its price momentum starts to slow. Investors, now sitting on significant gains and still hungry for higher returns, start to look for the next big opportunity. they begin to rotate their profits from the relatively safe gains in Bitcoin into higher-risk, higher-reward altcoins. This massive injection of capital into a much smaller, less liquid market is what ignites the wild, speculative frenzy of altcoin season. So the key signal to watch for is a decisive breakdown in the Bitcoin dominance chart after a prolonged uptrend. As of mid-2025, Bitcoin dominance has been in a steady uptrend for over a year, consolidating near the crucial 55 to 58% level. This is actually a healthy sign for the market, indicating that the bull run is being led by Bitcoin, as it should be. The trigger for a true market-wide altcoin season will likely be one of two events. The first possibility is that Bitcoin makes one final powerful surge toward its cycle peak. This would likely cause dominance to spike one last time before capital begins to flood out. The second possibility is that Bitcoin begins to trade sideways in a prolonged distribution pattern near its highs, boring investors who then seek excitement elsewhere. For investors, patience is paramount. Jumping into altcoins too early, before Bitcoin has finished its primary move, can be a costly mistake, as these assets often bleed against Bitcoin during its strong uptrends. The strategy is to wait for confirmation. Watch the Bitcoin dominance chart closely for a clear rejection from a major resistance level and the beginning of a sustained downtrend. This, combined with a stable or rising Bitcoin price, is the ideal environment for altcoins to flourish. Staying informed on these capital flows and understanding the pivotal role of Bitcoin dominance is really essential for timing the shift and capitalizing on what is often the most profitable, albeit riskiest, part of the entire bull market cycle.